Hello students. So starting with the last topic of the chapter 1, that is fundamentals of accounting, and the topic is rectification of errors. So we would be in this particular topic, we would be looking at that how errors or what kind of errors could be there in the ledger posting or in the books of accounts while we are drafting the financial statements. Such errors could be while drafting the accounts, as in the ledger accounts, or while we are transferring the balance of a ledger account to a particular financial statement, or once we have drafted the financial statements, an error could have been there, or while drafting of the trial balance, or from trial balance when we are finalizing the financial statements. During that time also such errors can be committed. So before we start off with the topic, let us first understand that what are opening and closing entries. So opening entries, so the opening entry is an item which is passed in the journal or the general ledger. So journal, as we all know, is the gist of all the entries or all the accounting transactions that happened during the particular accounting period, and journal ledger will again be the accounting transactions being recorded in such journal ledger, wherein we would have to see that such ledger accounts would be having opening balances from which have been carried forward from the previous years. So the purpose of passing this entry is to record the opening balances of the accounts which are transferred from the previous year to the new year. So such balances could be, for example, there could be sundry or the debtors balances, sundry debtors balance opening and closing. Likewise, there could be creditors balance, creditors account balance, bank account, cash account, fixed assets or intangible assets or current asset account. So all such entries or all such ledger accounts would have been closed, and the balances of the last year which will be carried forward and become the opening balances of the current accounting period would refer to as the opening entries or the opening balances of the accounts that have been transferred from the previous year to the new year. And the accounts that are appearing on the asset side of the balance sheet are debited in the opening entry, while the accounts which are appearing in the liability side are credited. So that is how they will have a debit balance when that particular account is open. So for example, in case of the asset account, we will always have a debit balance which will reflect here, and likewise in case of a creditor's account, we will always have a credit balance that will reflect here. So that is why we say that the accounts that are appearing on the asset side of the balance sheet will be debited in the opening entry, while the accounts that are appearing in the liabilities will be credited. And at the end of each accounting period, the books of accounts need to be closed for preparation of the final accounts, and also in the beginning of the new books of accounts are to be opened. So it's not that the ledger account that you have maintained, as we'll be maintaining it date wise. So at the end of a particular accounting period, that ledger account will be closed, and a closing balance which has to be carried forward in the next accounting period would be determined, and that closing balance, the closing balance for a previous year, would become the opening balance of the current period. So for example, closing balance of 2011 would become the opening balance, or which is being carried forward to the next period, that is the 2012, which becomes the opening balance of 2012. And for this purpose, opening and closing entries need to be passed so that one can determine that these are the new accounts which will be opened, and these such balances have been carried forward from the previous years, and thus their ledger account could have the first entry, that is the opening entry of that particular accounting period. And these entries are thus passed in journal. So the opening entries are passed only for those leisure account balances which are carried forward from earlier period to the current accounting period. In other words, the balances of assets, liabilities, owner's capital, equity accounts are only considered for such opening entries. So only those accounts which have the carry. So for instance, if in a particular asset account, or we have sold that particular asset in the previous year, so the balance, so there will be a nil balance of that particular asset, and thus that particular asset would not be carried forward to the current accounting period, as that asset has been sold in the previous year itself. So likewise, only those assets or only those liabilities would be carried forward in the current accounting period which has a debit or a credit balance in their accounts, which can be carried forward to the current accounting period. And the opening entry is passed with the closing balances of assets, liabilities, and capital account in the last year's balance sheet. And the entries that we have to pass on is, so all asset accounts would be debited, and all liabilities and capital accounts, owner's capital accounts, would be credited. So this is simple, that in the case of the opening, so it seems simple, but you do not have to commit any mistake in identifying whether it is a debit balance or it is a credit balance. And this is the most important thing that you have to pass on in the opening entries. And determining of the correct accounting balance and the correct opening balance of a particular leisure account or of general ledger as a whole is an important step for drafting financial statements. So because if you have correctly recorded the leisure balances, the opening balances of a particular leisure account, or for all the leisure accounts, then only the correct leisure accounts would be made for that particular accounting period. And also, now coming to the closing entries, so all the expenses and gains or income related nominal accounts must be closed. So when we talk about nominal accounts, we talk about the expenses or the incomes, gains or losses that are depicted in the P&L account of the business. And how does we close them? So in order to close them, they are transferred to either the trading account or the profit and loss account, and the journal entries required for transferring them to such account is called a closing entry. So before we finalize, so how do we start drafting the financial statements? Once the journal accounts or the leisure accounts have been prepared for all the respective asset, liability, income, expenses, then such incomes and expenses are then closed, and such nominal accounts would be moved to the P&L account. They are further evaluated listed in the P&L account. So expense on the debit side and incomes on the credit side. And after recording of such nominal accounts, we will be estimating the revenue of the particular business, and that revenue will then be transferred to the balance sheet side. And this is how we will start drafting and ascertain the financial statements of the business. So in order to start drafting the financial statement, it is very important to close all the nominal accounts and thus transfer their balances into either trading account or profit and loss account. So journal entries are thus passed when we are closing such nominal accounts and transferring them to the P&L account, and such journal entries are referred to as closing entry. So the closing entries are passed on the basis of trial balance for transferring the balances to trading and P&L account. And these entries are mainly for, so when we transfer the purchases, so basically when we transfer the purchases and direct expenses to the trading account, so then trading account has to be debited and all such accounts would be credited. So if this is the trading account, so in the trading account, opening stock will reflect here. 2 opening stock, 2 purchases, 2 factory expenses. So these are the direct expenses which are related to the purchase cost of a particular asset or of a particular machinery. So 2 factory expenses and 2 freight and cartage inward. So both of these are direct expenses. However, they will not be accumulated in the purchase cost, as these are not the amount, as these are not of the nature that the expenditure should be capitalized. Through freight and cartage input. And likewise, in the case when we are transferring sales and closing stock, so in the trading account here it would be by sales, by closing stock. So after determining and after recording the opening stock purchases, factory expenses, freight and cartage inwards, and then recording the sales and closing stock, we will thus determine whether the entity is having gross profit or gross losses, and then such profits would be carried forward in the P&L account. So moving on with the further entries, that would be, so we recorded the purchases, we recorded the sales and closing stock in the credit side, then carrying so further coming to the ascertainment of gross profit or gross loss, and how we will be treating them in the P&L account or charging them. So gross profit, we would be debiting the trading account and to P&L account. So we would be crediting the profit and loss account in the case of gross profit, and in the case of gross loss, P&L account is going to be debited and the trading account will be credited. So how do we transfer the expenses? P&L account gets debited and the respective expense account will reflect on so the respective expense account would be credited and such expenses would reflect on the debit side of the P&L, and incomes would be credited to the P&L account, thus reflecting on the credit side of the P&L account, and respective income account would be debited. And then looking at that, how will the net profit be transferred? So P&L account gets debited and such profit would be transferred to the capital account. So in case of net profit, P&L account is debited and the capital account is credited, and in the case of net loss, capital account is going to be debited and profit and loss account would be credited. So before we move on in the topic, let us take a look at the illustrations that are given in your study material. So the first illustration says, consider the following balances in the balance sheet as on 31st of March 2013, and we will have to pass the opening entries. So here we have the balances of 31st March 2013, and for the next year these will be termed as the opening balances starting 1st April 2013. So we have to pass on the entry, and we saw that all the debit balances or all the asset accounts would be debited and all the liability side accounts would be credited. So here we have to determine the nature of these accounts, whether it is an asset, whether it is a liability, whether it is a capital account, and thus we would be able to determine whether we have to debit or credit such balances. So as we see, this is owner's equity. So loan is also the liability of the business, plant and machinery being the asset, cash in hand again being the asset, balance at Citibank, again bank account balance again being the asset, trade debtors asset, closing stock again is the asset, trade payables being the liability for the creditors of the business, outstanding expenses being the liability. So as these are expenses which would be outstanding and would be cleared later on, so thus such expenses would be the liability, and prepaid insurance again being the asset. So it has been prepaid and this becomes the asset of the business. So now let us pass on the entry for the same. So the opening entry comes as, so we saw that plant and machinery account. So all the assets that we have listed would be the debit balance. So thus we would be debiting such accounts. So plant and machinery account, debit. Then we have the cash in hand account, which will again be debited. Then we have the bank account, balance at Citibank. Debit. Then we have the trade debtors account. debit. Then again we have the closing stock account, which is to be debited. And then we have the prepaid insurance. Right, so all such accounts. So the major part, if you see, is to determine what would be debited and what would be credited. After that, you simply have to put down the entry and your entry will be correctly recorded. So now prepaid insurance, and now coming to the credit balances, and then we will list down the amounts. So to Subodh's capital, because it is the owner's equity. Then we have to the loan. So the loan is again the liability, loan from HDFC Bank account to the trade payables and to outstanding expenses. Right? So now don't get confused in the outstanding expenses and prepaid insurance, or since we have already paid this particular insurance amount, so it thus becomes the asset of the company, and these are yet to be paid, thus become the liability. Therefore, two outstanding expenses. So outstanding expenses has been credited. Now putting down the amounts that we have. So for plant and machinery, the opening balance is 3,30,000. Then for cash in hand, we have 20,000. Balance at Citibank is 1,75,000. And then we have 3,55,000 for trade debtors. And then for closing stock, we have 1,35,000 and prepaid insurance 20,000. So both capital we have as 2,75,000. Then loan from HDFC Bank we have 4,25,000. And trade payables, so the trade payables come out to be 2,95,000. And the outstanding expenses come out to be 40,000. Also, one more criteria of ascertaining whether you have correctly ascertained the credit and debit balances is that after passing on the opening entry, the balances should match. And so like in the case of trial balance, the debit and credit matches. Here also, when we are evaluating and when we are passing on the opening entry, the debit and credit should match. So let us ascertain 3,30,000 plus 20,000 plus 1,75,000 and plus 3,55,000. Then we have 1,35,000 plus 20,000 comes out to be 10,35,000, and then adding 2,75,000, then 4,25,000, then we have 2,95,000, and then we have 40,000, which gives us again 10,35,000. Right, so this is how we pass on the opening entry in the books of accounts when an accounting period starts, and opening entry is nothing but the closing balances of the previous year ledgers which would be carried forward to this particular accounting period in the business. So the next illustration says pass closing entries for the following particulars as on 31st March 2013 by X Limited. So we have to pass on the basically close the nominal accounts of the P&L. So we have opening stock balance as 10,000, then we have the purchases, then we have the wages, the return outward, then the sales, return inward, and here we are finished with the trading account. So till here we have the accounts which will be whose balances which will be there in the trading account of the business, and salaries, being the expense, insurance being the expense, bad debts being the expense, interest received being the income, discount allowed, discount received, and closing stock. So all such would be accounted for in the P&L. Now let us take a look at how we will be passing the closing entries for the following particulars as on 31st March 2013. So now let us pass the closing entries in the books of X Limited. And such entries, so as we saw that such entries are first passed, so basically the nominal accounts would be first closed and then the such entries would be moved to the trading account and the P&L account, and thus the profit and loss would be determined for the business, that is the X Limited. So in the books of X Limited, so we would be first drafting these entries in the journal, and the format would be the date, then we'll have the particulars, leisure folio. So this is the journal, the format of the journal that we have also initially seen while reading about the concept journal. And amount, so this would be the debit, and amount, that would be the credit. And because we would be closing the account, so such entries would be passed on 31st of March 2013. So as this is the closing entry, so it would be passed on the last day of the accounting period. So to start with, so we had initially the opening stock balance, and so because it is opening stock, then we have the purchases, then we have wages, and also the return inward is also given. So return inwards is all the sales that have been returned. So then return inward is also being given and has to be debited in the trading account. So thus trading account debit to opening stock to purchases to wages, we have wages, and to return inward. So what is the total? So the amount that is being credited is opening stock is 10,000. Then we have the purchases, which amounts to 50,000. Then we have again the wages, which is 5,000, and return inward, which amounts to 10,000. So the total amount with which trading account is to be debited is 75,000. And here we'll put down the narration saying transferring closing balances to trading and P&L, to trading account. All right. So now the next after return inward, so we also have return outward as well as sales, which we will be crediting in the trading account. So on 31st of March, on the same date, we will pass on the entry. So sales account has to be debited. Then we have the return outward, which will again be debited. And we also have closing stock, which will again be debited and thus crediting the trading account. So the debit of sales, so the sales amount, sales we have is, so the total sales that we have is 1 lakh, which with the account will be the journal, in the journal we will be debiting such accounts. So the return outward is again 5,000. And the closing stock is 15,000. right? So the trading account comes out to be, with the amount that is being credited is 1,20,000. So now this is the credit, which is 1,20,000, and trading account's debit side reflects 75,000. So we would be ascertaining the gross profit or gross loss that the company or the business has incurred in the period 2012 and 2013. So let us pass on the entry. So because we have the income side is 1,20,000, so the income or the sales is more and the purchases is less, so we would be incurring profit. So thus passing the entry for the profit would come in the journal itself. So this is again date. So the profit that we have incurred would thus amount to, so trading account would be debited. In the case of gross profit, trading account debit to profit and loss account. Transferred. Right, so the amount that would be there would be 1,20,000 minus 75,000, which comes out to be 45,000. So 45,000 is the gross profit transferred to the P&L account. All right, now coming to the next entry, so we have the salary. So all the expenses would be, so profit and loss account would be debited, and the expenses would thus be credited in their respective accounts. So profit and loss P&L account debit to, so we have salaries, we have insurance, we have the bad debts, and the discount that we have allowed on our products while on the sale of such goods or products. So thus discount allowed will again be the expense of the company. So to discount allowed. So then the salary amount comes to be, so the salaries total is 8,000. But then we have the insurance, which amounts to 1,000. Then we have bad debts amounting to 3,000, and the discount allowed is 4,000. So here the narration would be being expenses charged or debited to P&L account. Alright, so in the case of, so now we are left with interest received and discount received, and such entry would be credited to the P&L account. So therefore, so the next entry that we have is of the interest received and discount received, which would be credited to the P&L account. So the same date, which would be 31st 12 2013. So the interest received account debit, and then we have the discount received account. So this discount is something which we have received from the suppliers. So discount received account again debited, and thus P&L would be credited with such amounts. So narration being balances transferred to profit and loss account. So thus interest received account is 3,000, and also discount received is 3,000, which brings the credit amount to P&L as 6,000. So now let us ascertain the profit or loss that would be charged in the P&L account. So this is the interest or the incomes that have been received in the P&L account, which is 6,000. The expenses that we have that the business has incurred or the X Limited has incurred is 8,000 plus 1,000 plus 7,000 comes out to be 16,000. So this is the P&L account would be debited with the expenses, that is 16,000, and also this is the profit that has been transferred from the trading account. So 45,000 plus this income that we have received is 6,000, which comes out to be 51,000. 45,000 plus 6,000 comes out to be 51,000 minus the expenses. So thus the profit here comes out to be 35,000, and which would be thus P&L account, so profit and loss account, which will be transferred to the capital account in the books of X Limited. So profit and loss account debit to capital account. Capital account. And what is the amount? It is 35,000. So the credit also being 35,000. So we looked at the opening and closing entries. Opening entries which needs to be passed on when the new books of accounts are being opened for a particular accounting period. So transferring the closing balances into the current accounting period would amount to passing the opening entries for such account balances, wherein all the assets would be debited and liabilities would be credited. And likewise, closing entries would be for closing the nominal accounts and transferring all such accounts to the P&L account or the trading account of the business. So now starting with the rectification entries. And what are these rectification entries? So such entries are done in order to rectify the errors, if at all, committed while entering the transactions of the business. So now these entries are passed when errors or mistakes are discovered in the accounting records, and these entries are also known as, so it can also be, such errors can also be termed as correction entries. So because there are n number of or numerous accounting transactions involved, so there has to be, or it is bound that a human might commit mistakes, or it could be so it could be any mistake, an error that can happen, while it could be an accounting error, or it could be a clerical error, or it could be a transactional level error, it could be anything. So such errors or mistakes, when discovered in the accounting records and when they are being corrected or being rectified, so that is what is called as correction entries or rectification of errors. And such entries again are also passed in the journal. So rectification entries is also part of the journal books of the books of accounts. And when the errors affecting the trial balance are made, the normal practice, so once the company generates the trial balance on completion of the posting of all the accounting entries in the ledger accounts, once the trial balance is generated, and in case there are certain errors that have been identified which are affecting the trial balance, what is the normal practice? The normal practice is to put the difference to an account called as suspense account. So all such differences would be put together in an account which is called the suspense account till the time the errors are located. So once and as soon as the errors are located, such accounts would be, or such transactions would be moved from the suspense account to the respective account. But till then, in order to start processing or start drafting or make a first draft of the financial statement, till that particular time the errors that are affecting the trial balance are put together in a suspense account, and then the task is to make the suspense account nil and transfer all the entries into their relevant accounting ledgers. And on identification of errors, the one effect, so how will we nullify this suspense account? One effect goes to the correct account and the other effect to the suspense account. So this is done for one-sided errors. Example, if sales book total is wrongly taken but individual customers are correctly debited. So usually the suspense account treatment is done for one-sided error. So for instance, the sales book is the total of the sales book is wrongly taken. However, the individual customers, once checked or once evaluated, show the correct debit entries. So then in that case, what will happen is there would be a single effect that would be given to the sales book in which the error has been, or in which the total is being wrongly taken. So continuing with the example, and in the case of the sales book, the sales total is wrongly taken. So what will happen is that error will cause difference in the trial balance, as only sales account is wrongly credited. And in that case, once it is identified that only a single impact or one-sided error has been done, then in order to correct that, the rectification entry will be thus passed through the suspense account, and the amount that we have taken from the suspense account would be thus transferred to the sales account. And in all other cases, rectification is done by debiting or crediting the correct account head, and by crediting or debiting the wrong account head. So the reverse impact will be given. So what happens is, initially you find the errors that are affecting the trial balance. You put all those error or all those entries in one account, that is the suspense account, and as and when you realize the mistake, then you take that particular transaction and give it a reverse impact, so that the particular transaction is correctly recorded and is reflected correctly in the trial balance, and also in order to nullify the impact of the same in the suspense account. What are the types of errors while we are rectifying the same or looking into the same? So how it is important and why it is important to identify the type of error, as it will help us in understanding how that particular error should be corrected and rectified in the books of accounts. So the first error is error of principle, which says entering revenue expense as capital expense or vice versa, or entering revenue receipt as capital receipt or vice versa. So such error of principle can also be done, and one can make a mistake while determining the nature of that particular expenditure, whether it is a capital or revenue expenditure. And in cases of receipt also, same mistake can be done, that instead of considering it as a capital receipt, such receipt has been considered as a revenue receipt, and that type of an error will be called as an error of principle. So how is the rectification done in case of error of principle? A journal entry is passed in order to give the correct effect. Now, error of omission, so transaction forgotten to be entered in the books of account. So how will you rectify this particular? So you have completely forgotten that particular entry and not recorded in the books of accounts. So that how can you rectify this error? By simply entering the correct entry in the books of accounts, and it could be in the journal directly. Errors of a commission, that could be entering into the wrong head of the account, and debit or credit wrong account head and post it to the correct head. So if we have made an entry in the sales account, however that which is wrong, and it has to be done in the interest received account. So what we will be do, since we credited the amount here, so the amount credited would be debited here and transferred to the amount in the interest received account, which will there be credited, amount credited. Right now, compensating errors, more than one error that could compensate effect of each other. So in case there are some errors that have actually compensated for each other, and once we ascertain those errors, we will simply pass the correcting entry and nullify and also compensate for the errors. So for instance, if the debit has to be done in the asset account and we have created an expense account for such a debit, then such expense has to be nullified and the correct asset account needs to be debited. Now, wrong totaling of the subsidiary books. So as it will definitely affect the TV, because if there is a totaling error, it could be easily depicted in the trial balance of the books of account. So it would be done. So such rectification would be done through the suspense account. Posting on wrong side of an account. So pass an entry with the double effect one to cancel the wrong side and the other to give effect on the correct side. Again, posting of wrong amount, pass entry with the differential amount. So for example, if there is a sale transaction that occurred for 8,000, however in the books of account it has been recorded for only 800, so the differential amount, that is 7,200, one more entry would be passed in that particular account for rupees 7,200, and thus making the total of the amount exactly the same of the nature of the transaction. So these are the errors, and this is just a table for your reference that how you need to rectify the errors, the error of principal, the error of omission, error of commission, compensating errors, wrong totaling. The idea is you have to probably first imagine that once you have made the correct entry, how would the books of accounts depict such an entry, and then in order to bring the correct entry impact, you have to reverse the impact or probably give the double impact. So this is what needs to be ascertained depending on the type of error committed. Now moving on, looking at the errors that could have been committed and at the level and at the different stages on which such errors could have been committed. So it could be either before preparing the trial balance, and the errors could be either double-sided errors or either single-sided errors. Such errors can also be estimated or identified after preparing the trial balance and during drafting of the financial statements, and also such errors could be either double-sided errors or single-sided errors. And the most crucial and the challenging part is after preparing the final accounts, some entries have been ascertained as incorrect, and such errors could also be double-sided or single-sided. So let us now take a look one by one as to how rectification of such errors, once identified before preparing the trial balance or after preparing the trial balance or after preparing the final accounts. In case of the double-sided errors, the impact or the entry has been wrongly done. So it could be errors of omission, error of principal. So double-sided error will involve both the accounts as to the account that needs to be debited and the account that needs to be credited. The error has been committed in case of both the accounts, and in case of single-sided errors, in one account, the entry has been correctly recorded. However, the second impact or the single impact is something that needs to be corrected. So that is what we are going to take a look in while proceeding further, that in the case of double-sided, how we make a rectifying entry, and in the case of single-sided error, how we make an entry. And then again, the three conditions would be before, so once the error is rectified before preparing a trial balance, how such entries are done, after preparing the trial balance, how such entries are rectified, and after preparing the final accounts, what are the challenges involved after preparing a final accounts, that the entries, whether the entries needs to be rectified and how such entries will be rectified. So moving on, let us take a look at the first adjustment that needs to be done. So before preparation of trial balance, if the errors are detected before preparation of the trial balance, the effect of each error should be known. So if we are detecting an error before the preparation of the trial balance, and once the error is identified, so whosoever identifies it should know the effect of the error and thus give the reverse impact in order to bring the correct impact of that particular entry. So and as we know that there are either double-sided error which will impact both the accounts, or both the account that needs to be debited and the account that needs to be credited. Both such accounts are impacted, or incorrect entry has been recorded at both the sides of that particular entry. So that is a double-sided error. And in case of a single-sided error, the impact has been recorded in one account or in one. So either debit has been done incorrectly or credit has been done incorrectly. So for instance, if we take an example of a credit purchase being recorded or being omitted from the books of accounts, or from a purchase daybook. So now this is an error of omission which would be considered as a double-sided error for the simple reason that we have omitted this credit purchase. So the account that needs, so for example, from a credit, so the creditor account has not been credited, the purchases account has not been debited, so both the account have been impacted, and the entry has been totally removed or omitted from the books of accounts. So this will be termed as a double-sided error. And in case of single-sided error, if we say, so for instance, credit purchases have been recorded but in an asset account. So that purchase has been recorded, however, it has been considered as a purchase of an asset. So the asset account is debited. The credit account has been credited properly. However, the debit impact has been given or recorded incorrectly. So this is a single-sided error. So here the entry, so the credit effect will not be impacted or will not be rectified. Only the debit impact or the entry related to the debit impact would be done. So what would be the correct entry? We would be nullifying the asset account, as this is a credit purchase related to the goods and services in which the business is dealing. So we needed to, so the correct entry would be, or the correct impact is that credit purchases or the purchases account needs to be debited. Purchases account debit to asset account which has been incorrectly debited. So in order to bring that nil impact, we would be debiting the asset account, and in order to correctly record the purchases, we will be debiting the purchases account. So this would be the rectifying entry in case of a single-sided error. So now here, as we see that in case of a double-sided error, the following principles should be followed for the purpose. So ideally, in the case of a double-sided error, we would understand, so the entry that has been completely omitted, first we would see that what is the correct entry, what are the two accounts that needs to be impacted, and what entry had been done. Also, like in this case, the entry had been completely omitted. So there could be instances where an incorrect entry has been done and the impact has not been recorded in both the accounts, neither the debit account nor the credit account. And then after analyzing the wrong entry, we would understand and try and analyze and pass on the rectifying entry in order to bring the correct impact. So what do we understand here? That in either of the cases, we have to first identify the correct entry, look into the books of accounts that what entry has been done, and after that rectify the entry in the case of before preparation of the trial balance, right? And in the case of after preparation of trial balance, if the errors are detected, the following procedure should be followed. So the errors would be the same. It could be either the double-sided error or a single-sided error. So in the case of double-sided error, same method needs to be followed, which we have learnt in before preparation of trial balance. So first, to identify what entry is to be made, what entry has been made. So first, to identify the correct impact or entry. Then look into, so this is the first step. This is the second step. Look into what entry has been made. And thirdly, passing on the rectifying entry. So this is the same principle that will be followed in the case of double-sided errors even after preparation of the trial balance also. However, in the case of single-sided errors, relevant account needs to be rectified by applying the suspense account. So once we solve the illustrations, you would understand that how in the case of a single-sided error, we will pass on this particular entry involving the suspense account. So just to give you a gist or a heads up on the same, so what is done is once you prepare a trial balance, right? So the debit and the credit ledger accounts, or the total of debit and credit, is identified or listed down. So for example, the total here is 25 lakhs. However, the total of the credit side is 24 lakhs. So by the look of it only, we identify that the trial balance is not matching and there is a difference of 1 lakh. So now this particular difference of 1 lakh is then transferred to the suspense account, and by further scrutiny of the trial balance, once you start analyzing and identifying the errors that are there in the trial balance, or or the differences that are there in the trial balance, once you start identifying those errors and start rectifying such entries, so if a single sided error impact is identified, so then what will, so for instance, if you saw, or if so for instance, if you identified that a particular asset account has been wrongly credited, so that asset account would be debited, and the credit impact which has to be reversed would be reversed from the suspense account. Right, so this is how we would be rectifying the single-sided errors after preparation of the trial balance. So now, what is a suspense account? And if the trial balance does not agree, we cannot prepare the final account. So thus it is important, in order to start drafting the final account, it is important to first match the trial balance. And in order to prepare such final accounts, the difference so appeared in the trial balance is to be passed through the suspense account. So when the errors will be located and rectified, suspense account will automatically be nil or closed. So like I said, as we identified the difference of 1 lakh, this difference will then be moved to the suspense account. And once you start identifying the errors and passing the rectifying entries, eventually this difference will brought down to nil, and thus we will close the suspense account, which will hence result in matching the debit and the credit balances of the trial balance. Hence, we can further decide to, or the company can further move on to preparation of the final accounts. So the suspense account will appear in the balance sheet, and when it appears in the debit side, the same will appear in the asset side of the balance sheet, and vice versa. So this is in case the suspense account has not been closed and still, so the management or the company has not been able to find out complete difference of the the debit and credit mismatch. The difference has not been properly identified or completely identified. So then in that case, if there is an account balance still that is remaining in the suspense account, then suspense account will appear in the balance sheet. And in case of the debit side of trial balance, in case the suspense account appears on the debit side of the trial balance, so it becomes the it comes in the asset side of the balance sheet, and then vice versa. So if it is on the credit side of the trial balance, then it would be reflected on the liability side of the balance sheet. And after preparation of final accounts, how double-sided errors and single-sided errors need to be rectified in the books of accounts. So if the errors are detected after preparation of final accounts, the following steps should carefully be followed. So for double-sided errors, same as before preparation. So basically the impact that needs to be recorded, that needs to be recorded or rectified, that needs to be recorded or rectified in case of double-sided errors would be the same. So even if would be the same, So even in case of whether the error, that double-sided error has been identified before preparation of the trial balance, after preparation of the trial balance, or after preparation of the final accounts, the effect or the impact that needs to be corrected or the rectifying entry that needs to be passed would remain same, and there will be no difference in reference to the accounting treatment in the case of double-sided errors. However, there is an adjustment that needs to be kept in mind while we are rectifying the entries after preparation of final accounts, which is that all the nominal accounts are to be prepared by profit and loss adjustment account. So if in case the rectifying entries involve the nominal accounts, what are the nominal accounts? Nominal accounts, with nominal accounts we mean all the expenses account, losses account, incomes or gains account, all such accounts which reflect in the profit and loss account of a particular business would be termed as nominal accounts, and entries or rectifications related to such nominal accounts should be replaced by profit and loss adjustment account instead of their direct account. So we will not be bringing that particular the impact of the rectification in directly in the nominal accounts. However, it would be done through bypassing the entries through profit and loss adjustment account, and the rest one will be same as A or B earlier. So the treatment otherwise would be same in case of double-sided or in case of single-sided error. The only thing that needs to be kept in mind is that in the case of the nominal accounts related rectification entries, the entries need to be replaced by or to be passed through the profit and loss adjustment account, and the direct accounts would not be debited or credited. So suspense account will be carried forward to the next year, and the real and personal accounts are to be carried forward to the next year. So thus nominal accounts related adjustments would be replaced by profit and loss adjustment account. However, in the case of suspense account, we can carry it forward to the next year, and then once that error is identified in the next year, such an error could be rectified. Likewise, in the case of real and personal accounts also, they would be carried forward to the next year, right? And so looking at effect of such errors on profit and loss. So some errors may affect the profit or loss for the period while other won't. So it depends that if it is affecting the nominal accounts, or if the entries or the errors are affecting the nominal accounts, then definitely such errors would have an impact on the profit and loss account. However, if the errors are related to the assets or the liabilities of the business, then they might not impact the profit or loss of the business. So as the question says, how to find it out? The P&L account reflect items of incomes, gains, expenses and losses, and all such accounts are nominal accounts. So in case when an error occurs which affects a nominal account, it will thus affect the profit or loss, otherwise it won't. And the errors that will affect the real and personal accounts. So like I said, real and personal accounts means owner's equity, capital accounts, etc. And here real means assets and liabilities account. So the errors related to such accounts will not affect the profit or loss. So thus this completes the conceptual part of our chapter number 1, and we would be starting off with the illustrations on this particular topic, and then moving on we would be looking into some of the questions that are given in the study material which are important for you to practice. So either we will discuss it in the class or we will solve it in the class. So in case we are discussing it in the class, that does not mean that you are not solving them. You can solve them anytime after you complete your lecture, as more and more practice will make your concept stronger and also improve your speed for the examination and make you more confident in terms of a particular topic or a particular chapter. So see you all in the next lecture. Bye bye.